Gentlemen, if you are a young family man in your 30s carrying the weight of being the sole provider for your household on your shoulders, you've probably had thoughts like, am I doing this right? Am I making the right moves with our money? Could I be doing this better? In this video, I'm going to unpack for you 5 of the common questions that you are asking yourself that are keeping you up late at night and what you could be doing to ensure you're making the right moves with your money. First, will they be okay without me? Question for you. If anything were to happen to you and your income were to immediately stop tomorrow, for how many months could your family survive financially without your income? Would they have enough money to pay the bills, to pay for food, to pay the mortgage, and maybe cover college? If the answer is no, or I'm not sure, this needs to be your number one priority. Every breadwinner needs life insurance and not just some random policy. You need to make sure that you have enough coverage to pay off your debts, including your mortgage, replace your income for at least 10 years or longer, and cover any future financial needs your family may need. Now, term insurance is very cost effective, but it does expire at some point. Permanent life insurance, on the other hand, will last you forever, but it's more expensive. A combination of the two usually gets the job done. The other side to this is, what if you were to get sick or injured and you can't work? Your income still stops tomorrow, but now your family takes on additional medical debt. This happened to a young gentleman I met that was 35 years old that got injured on the job, and unfortunately, he had to go through everything he saved just to survive financially. He had to burn through his kids' college funds, he had to burn through his retirement accounts just to keep the family afloat. This is where products like disability insurance and living benefits come in. Disability insurance steps in if you can't perform the functions of your job, and living benefits steps in if you are to get diagnosed with anything that is considered critical, chronic, or terminal. These are very severe injuries on the living benefit side, but this allows you to have money coming in to support you financially while you are recovering. A death or a severe injury to you, the breadwinner, could drastically affect your family financially. This is why it's so important to have basic insurance protection in place. It's not optional. Another common question, what percentage of my income should I be saving? First, you need to figure out if you are the saver or the spender. Then from there, I recommend following the 50-30-20 rule, which states that 50% of your income should go towards your needs, which is your living expenses. That's your mortgage, that's your food, that's your transportation. 30% of your income should go towards your wants. This is going to be things like travel. This might be dinners out or hobbies. And then 20% of your income should go towards your savings. And this gets broken down into a few different categories. You should always make sure you have at least 2 months of your living expenses saved in your basic bank account for easy access to cash. Then from there, you want to build up at least 4 months worth of your basic living expenses saved in a high yield savings account. And you can simply just go online and Google high yield savings account. A bunch of options will pop up. I recommend picking a bank that has above a 4% interest rate on their high yield savings that is FDIC insured. A lot of times this is the online banks. It's not your basic checking or savings accounts. Then from there, once you've done that, you can start looking at saving for some luxuries, maybe saving for some larger purchases, then of course saving for your kids' college and saving for retirement. This leads me to the next big question, which is, what if I can't afford to send my kids off to college? An article came out by CNBC with this statistic from Vanguard that says, in 18 years, a college degree could cost about $500,000. Parents, that's insane. If we don't start saving today, our kids will graduate drowning in debt. So just to give you an idea, if a parent just started saving just $50 a month, every month for the next 18 years, by the time that kid goes off to college, they would have approximately $24,000 saved. If they started saving $100 a month, they would have approximately $48,000 saved. If they saved $150 a month, they would have approximately $72,000 saved. And if they started saving $200 a month, 18 years from now, that parent could expect to have just shy of $100,000 saved for their kid when they go off to college. And that helps just make a dent in what a college degree is going to cost 18 years from now. The key is it doesn't matter necessarily how much you start with, it's just that you get started saving something now. This leads me to the next big common question, which is, how am I supposed to retire us? Now again, the key is just to get started saving something. Eventually you want to be saving 20 to 30% of your income, but you've got to start somewhere. And where you start saving that money is going to depend on your answer to these 2 questions. Question number 1, what do you think is going to happen to taxes in the future? Do you think they're going to go up or down? Question number 2, what is your comfort level with risk and the unpredictability of the stock market and your comfort level with losing money. If you think taxes are going to go up and you don't want to deal with losing money, I would recommend looking at an IUL, which is a financial tool that you can save money into, where your money grows accessible in the future, all tax-free, and you can't lose money based on the stock market. Now, if you think taxes are going to go down in the future and you still don't want to deal with any stock market risk, then I would recommend taking a look at an FIA, where again, this grows your money mirroring the market, so you get market-like returns, but you don't have to deal with any downside risk. But it does grow your money tax deferred, which means you're going to pay taxes on the growth of that money when you take it out in retirement, which if you think taxes are going to go down, that would be beneficial. Now, if you think taxes are going to go up, but you're okay with some risk on the return of your money, I would recommend taking a look at a Roth IRA or Roth 401k, because those are going to grow accessible in the future tax-free. But you are susceptible to the stock market. So you can earn really, really good returns, but you can also lose really, really, really big returns. And finally, if you think taxes are going to go down in the future and you're still okay with the stock market volatility, I would recommend taking a look at a traditional 401k or a traditional IRA, because this is going to grow your money tax deferred, meaning you'll pay taxes when you take it out at retirement, which would be beneficial too if you think taxes will go down. And it's also in the stock market. So if you're okay with a lot of risk, then this is a good strategy for you. In my personal opinion, the key is diversification. You don't ever want all of your eggs in one basket. So take a look at your answers to those two questions and see what makes the most sense for spreading out your resources. And the fifth question that we're going to dissect for you today is, how am I going to be able to do all of this if I'm working 40 plus hours a week and I'm barely making enough to get by? Friends, it's not about working harder, it's about working smarter and making more money per hour. Now, that might mean that you need to go out there and increase the value that you bring to the marketplace in your field. Maybe you need to go out there and take a course. Maybe you need to do an internship somewhere. Maybe you need to go out there and study under some people that are making more money so you can learn how you can bring more value to the marketplace, which is ultimately going to raise up your income. And if you've reached the glass ceiling where you're at and you can't possibly make any more money, it might be time to try something else. I'm a big believer in people getting into some kind of an uncapped commissionable sales role where you get paid for directly the value that you bring and the work that you do, versus somebody telling you that you make X amount per hour. For example, I teach people how to get out there and help clients with insurance and investment financial products, and it's one of the highest paid industries in the world. There's a gentleman that I had coached a few years ago that was making $65 an hour as a physical therapist, about $124,000 a year, and he was still living paycheck to paycheck in Southern California. When he came on board with us, he was able to completely replace that income here on a part-time basis, and he's projected to make over $500,000 this year just being in this industry for just a few short years. So my question to you, you breadwinners out there, is what type of vehicle are you driving when it comes to your career and your income? Is your career in a Prius or is your career in a Ferrari? No disrespect if you drive a Prius, but just using it as an example for one's going to move a little bit faster than the other, and one can just drive you a little bit closer to the income that you need to make to support your family with the goals that you have. Now, gentlemen, I'm sure you have additional questions besides just the 5 that we covered today. And that's why I created this YouTube channel, to give you all the resources you need to get your money questions answered. I've linked 2 videos here that will dive a little bit deeper into some of the things we talked about today, but make sure you subscribe so you don't miss another video teaching you how to manage your money correctly. And please also share this video with any other breadwinners you know out there. I will see you back here next week on YouTube.